What's up, Gould Miners? Today we welcome Zach Zimmer to the program. Zach is a single-family home investor and over the last decade has amassed a portfolio of over 50 rentals in Northeast Ohio. And while he has made millions of dollars as a real estate investor, he's also lost millions of dollars. And in this episode, we dive deep into the wins and the losses and the lessons that Zach has learned in the process. We kick off the episode with Zach detailing his start in real estate investing and how he went from a W-2 employee to eventually flipping, rehabbing, and buying single-family rentals at scale. Later on in the episode, Zach goes deep into the expensive lessons that he learned investing into real estate syndications from 2019 to 2021. And then finally, we conclude the episode with Zach giving a breakdown on the rent-to-own strategy that he uses for his current portfolio. We really get into the nuts and bolts of it all with this particular strategy and why Zach has decided to use this strategy to grow his portfolio. Whether you are an active investor that's looking to grow a single-family portfolio, or you're a passive investor that's looking to invest into more passive real estate opportunities like real estate syndications and funds, there is something in this episode literally for everybody. Zach shares a ton of really valuable insights and perspective for both active and passive investors alike. So without further ado, everyone, let's welcome to the show, Zach Zimmer.
The Gould Mine Podcast.
Zach, welcome to the Gould Mine.
Hey, thanks for having me, Danny. Glad to be here.
Yeah, man. This is going to be a lot of fun, and you actually got started in the same sector that I did, residential. So you, what were you doing before you got into single family investments?
I mean, I was doing the American dream, right? Working a W-2, saving a 401k, doing an IRA. And getting all the pieces of paper that say I'm smart, right? And not the ones that I collect now. I collect very different pieces of paper now, but yeah, I collected the pretty prestigious undergraduate degree in manufacturing management at a co-op university where we switched back and forth every 3 months, work in school at different companies that wanted these people, coming out of college different, right? They didn't want somebody with just 4 years of scholastics. They wanted somebody coming out with 2.5 years and 2.5 years of real world work experience. So a great small college came out with a manufacturing management degree, which put me more in like supply chain and in operations of manufacturing companies. That was in Michigan and Mexico. I worked in Michigan and Mexico. And I'd wanted to come back to Ohio after being up. I was up there in school for 4 years and another 4 years after that. And all my family was in Ohio. And the price of real estate in the suburbs where I was, nice suburbs of Detroit, was pretty high. And so, I came back to Ohio in 2005. And, originally it was like, I'll just rent an apartment like I was. But things were good, and I ended up buying a new construction kind of small local builder house. So that was my first owning real estate at 25. And, I was like, I remember I was paying extra to principal each month, or I'm like, I'm going to pay this thing off in 20 years and I'm going to save this 401k. And that was really all I didn't know anything about real estate. And then I ended up getting married 3 years later. We jumped into another, like a super nice model home because this was 2010. So, the market was not great, 2009 and 10. And we got a nice, great custom home. And I'd been hearing about people at the company I was at. So I was working my way again up that company, got an MBA. I jumped into an industrial company in bearings and steel, the Timken company. And, I was still, up at 5 a.m. in the gym, at the office at 6:30, running around there, just working my way up in this company. And I'd been hearing about guys buying rentals.
Yeah.
And the Timken company, when you got into more of a senior individual contributor or in management, you got a nice bonus, a decent bonus, 10 or 15 or 20. It just kept going up with responsibility. And these guys would take that bonus and they would go put their 20% down or what and buy a duplex or buy an apartment, buy a single family. And I was like, oh, that's smart. So instead of just getting that, $10, $15, $20,000 that disappears within 6 months or a year, right? New furniture, maybe a new car, vacation, new clothes, a home remodel, you're putting it into something that's going to pay you, maybe $300, $400, $500 a month in perpetuity.
Right.
And so that caught my interest. I was not in management yet. And so my bonus wasn't too much. And we were, even though we both worked at this company, my wife as well, we were dinks. We were that double income, no kids.
Yeah.
But we spent like it, we spent. I mean, I was saving 401k, so was she. So we weren't as bad as like a lot of my tenants are now. And like most of, the majority of America. But we put aside, call it 20%, and then we lived on 80%. So, our savings and checkings account, had a couple $1,000 in it or something. And so I didn't have that down payment money. And I remember going to my dad and asking him for a loan. My dad did pretty well. He had a family business. Yeah. And I asked him, and I put together kind of everything in an email of, hey, here's what it's all going to look like. And I had gone out and looked at like a C-level duplex in Canton City. And I was like, okay, I'm going to buy this for 45 and to do this. Each side rents for 500 and I'm going to cash flow. I'm going to be able to pay him $300 a month or whatever. And I'm going to cash flow $300 a month. He turned me down. My dad shot me down. I remember like, oh, he doesn't get it. And I had read Rich Dad, Poor Dad in 1998, like 2 years after it came out. It was given to me by a guy in, not Amway, but it was in an IBO, pyramid type sales company. I think it was called like Quick Star or something. And, the book hit, right? It had like ahas, and it had things that would, were brand new to a 17, 18-year-old. But then, how it was given to me was somebody trying to recruit me in sales and then try and recruit more people. And so, so I heard some of the lessons in there, but it came to me in a sleazy, salesy way. So it wasn't something I like fully digested and took action with. But when my dad turned me down, I was kind of like, oh, he doesn't get it. The poor dad, he doesn't get it. He doesn't understand it. Yeah. And even though he was the wealthy dad, he just, he didn't spend, he saved and invested. But, it's in hindsight, had he given me that loan, likely would never have built what we did, because my first experience in real estate would have been Canton City, C-class, C-minus duplexes. And I'm having, likely, probably 50-50, whether it would have gone well or it would have been horrible. And I said, never buying rental real estate again. Yeah. But, he said no. You fast forward like 4 or 5 months, I had gotten promoted already. I was a manager and I got a 20% nice bonus. And so that was like, it was about a $24,000 bonus. And I had pivoted to single families. Okay, single family is going to have better tenant, more of a non-transient tenant, like a duplex or apartments do, right? That's somebody's short-term place. Nobody says, oh, I want to live with a shared wall for the next 20 years. But people do stay in a single family home rental for 5, 8, 10 years. Yeah. And so I had identified a house, and at that time, so this is 2012, the banks were still doing carpet, paint. I mean, they were turning these things around, all these foreclosures, finally coming back on the market. They were making them turnkey. This one was $42,000, a 3-bed, 1-bath, new carpet, new paint. Kitchen was good. Bath was good. Had a dimensional shingles. The only downside on it was it had the original wood windows, but they were all fine. They'd just been painted inside and out. So everything was, no peel and paint on them. So I get that one under contract. And while that one was under contract, another one hit the market 2 blocks away in this city that I had been targeting based on others telling me about it. It's an Akron suburb. And this other one hit the market 4-bed, 2-bath built in 2006 on just like a stranded parcel that someone had sold off, because this neighborhood was built in the 50s, but somebody had an extra parcel and finally sold it off, and a builder built in 2006. Well, that house got foreclosed, and I was able to get that under contract for 50. And well, before I got under contract, I remember calling my loan officer like, hey, can I buy 2 houses? And, I don't remember her exact response, but I always say, I think it was something like, oh yeah, no, they're looking at 2 W-2s, right? 780 credit scores, 2 W-2 incomes. Oh, you want to, buy a $40,000 and a $50,000 house? Yep. All right. Just bring more money to closing for your 10% down was what all it was back then.
Yeah.
And yeah, those first 2 houses were Huntington 30-year fixed, 10% down. And that took basically all my cash. And so that was the biggest decision, or that first decision to change our life, right?
Okay.
To not be dinks living paycheck to paycheck, but to take that $20,000 that could have been an amazing vacation, new patio furniture, new this, new that, and put it away in 2 houses that, oh my goodness, like seems like it's going to work, but there was a gamble, a risk.
Yeah.
And it was at that time, the title company, I was talking to her and, heard about rent to own. And I was like, well, that's what, I don't want to deal with transient tenants. Like, I've got a significant engineering job. We were pregnant at the time. Like, I'm about to have a newborn. I got this engineering division. I got this and that. Like, I can't be dealing with transient tenants. So that was when right from the beginning, I went into this rent-to-own strategy of, trying to find more of an owner-occupant mentality. And the biggest difference, because it gets a bad name, rent-to-own gets a bad name because people are doing it either to be predatory and take lots of down payments, right? Take $5,000 or more down payment, only give them 12 or 24 months, and then they're out. Or they really have to sell the house. So that could be the other reason why they only want to give them 2 years. And unless you are screening really well and creating, kind of putting these thresholds, like if you're only giving these folks 2 years, they'd better have a 650 credit score now. They can't be coming out of a bankruptcy. They can't have a 500 with like medical bills and car issues, all these things, because they're never going to get that loan. And you're going to be kicking them out and evicting them and keeping that money. So
right.
I give people forever. There is no end. So you can buy that house in 1 year. You can buy that house 10 years down the road. I give them forever because my objective isn't to collect down payments. It's not to have to sell the home next year or 2 years. So I just want that owner-occupant mentality, and they can be renting it forever. Just, taking care of it different, transient tenant. So I loved that. I loved that concept. And so I started that in 2012 and, didn't even know what I was doing. Like I said, it was kind of like, hey, that's our bonus. That's it. And we were done. And we bought those 2 in 2012 and didn't buy any more because I didn't see it as like a business or as like a way to walk away from a 6-figure W-2. Like there was nowhere in the concept of an idea. Right. There was no podcasts in 2012 and there were bigger pockets and there weren't people. You didn't know anyone. You can go on social media now, right? And probably find, if you needed to, you could probably find 100 people retired living on passive income, in an evening by just doing searches. Well, that wasn't a thing in 2012. So you'd heard of like somebody's uncle had some rentals and he used to spend his weekends changing carpet and, you'd hear those stories. You didn't know of an example like mine of you're walking away from a 6-figure W-2 at 39, making 3 times what I made as a director of engineering. Like you didn't hear that.
Right.
So it just took time to slowly, okay, I got a little bit more money. Oh, we can buy a house. Oh, there's a bank that'll lend on the rehab. Oh, so actually at closing, I'm not bringing any money to closing. They're getting me a check because the house is appraising for so much more than I'm buying it for. They're funding the rehabs. And so it started like that and then flipping and then by 2015 is where I could kind of see what this could be. So I'd probably bought about 4 more in 13, 14 and struggled with contractors, struggled with agents. But by 2015, I had 2 great agents that were just running around looking at houses. Like I didn't have time to look at houses, right? I work a full-time career. I have at that time then. So we had 2 kids back to back, 2012 and 2013. I traveled for my job. I had plants around the country. So I needed to trust agents to go look at houses and not leave me there. And so in 2015, I had 2 different agents covering 2 different counties. I had a phenomenal contractor that basically started working full time for me. And then for about 3 years, like 15, 16, 17 was about a house a month. So I did about 36 more with flips because we were flipping some too, but grew rentals over 30 in those 3 years, flipped probably 3 or 4 a year. And, my background developed into more Lean Six Sigma, if you've heard that term, which is continuous improvement. And it's a Toyota principle that GE also came in with, but it's basically a mentality of accomplishing the objective with the fewest resources necessary. And, we had lots of training and lots of problem solving, but we always talked about tools in Lean Six Sigma. So you had all sorts of different methodologies for solving problems. You had different tools. And we would say different tools in your toolbox, a 5Y, a fishbone diagram. Well, what I've talked about with flipping is I didn't want to flip. Like I didn't like it, but it was a tool in the toolbox when a house didn't make sense as a rental. And that's why I tell everybody, like, if you want to be successful in real estate, you got to have all the tools. You can't just be a wholesaler or a flipper or just buy and hold, because you want to be the guy they come to for any type of deal, because, we know that whether it's a flip, whether it's a buy and hold, whether he's going to wholesale it, like he'll buy them all. And so, when great things came across my plate or were out on the market, I trusted the realtor and the general contractor, and I just bought the house, and the realtor would pick the finishes and pick all that. Contractor would execute it, and then the realtor would sell it. And so that helped to fund what ended up becoming package burrs. So if I'm buying a house a month, I'm buying them in cash, rehabbing them in cash, and then I'm taking them to a lender. And yes, that used to be very hand to mouth, as I didn't have a lot of cash. But then once I had enough cash, which the flipping helped, and living below our means, which we'll talk about again. But now I was able to only go to a lender like once a quarter, once every 6 months, and take 4 houses to them. Okay, community bank, here's the 4 or 5 houses. Yep, just let me know access. I'll coordinate with the tenants, get them all appraised, and give me all of my cash back. And those were profitable because they would appraise, call it, a package of 4 houses would probably appraise for 150 to 175 or more than my all in. So, after leaving 75% loan to value, so I got to leave 25% in them, I get all my money back, and I would still profit about, 10 to 15,000, tax free in my pocket per house. So you're pocketing 50,000 on a package burr, and then you're cash flowing. That's cash flowing around $400 to $500 per house. So you do that package of 4, there's 2,000 a month in your pocket. You have no money left in them. So, continues to be that return on investment of infinity.
Right.
And that's the same dollar, just keeps going in and out.
Right.
And so that moved me through till 2018. And it was up over 50 houses, and I kind of felt like, I've got enough. And at times it was a lot of work, right? So even though I still handled showing and filling when I would have a vacancy, because I wanted to meet this person.
Oh, wow.
I couldn't outsource that. Like I can't have somebody else fill it, and then I'm going to deal with these people for the 2, 4, 6, 8 years, collections and because the majority of my time now is, just, it's not a lot of time, but collections, just dealing with payment issues because they're responsible to take care of them. So, in 2018, I was like, okay, let's start something else. Like I needed to start doing something else. So I started doing some partnering. I started doing some lending. And early 19 was when I went into my first syndication. And I'd heard about it through a podcast that I listened to. He had these folks on. He was investing with them. And it's in the hospitality space. And it's amazing what they've done. I mean, this is a winery, golf resort, boutique, 100 bed, maybe 75 bed, weddings. I mean, weddings is where they're making millions a year. They're crushing it on weddings because it's just such a great location. But lending has hurt us there. So the lending landscape for hospitality changed after COVID. So right now we have our plan was, refi out 75% loan to value. And now the appetite is more like 55% loan to value.
Yep.
And so there's $20 million of created value stuck in this property. But so my issue with them then is, okay, right, our debt service is well below our target, right? Because we haven't been able to cash ourselves out. Well, then why are our payments? Why are we getting payments, much higher than just the 6% pref? Right? If our debt service is $20 million below, so that means our monthly debt service is much below plan. So we should have a lot more expendable income to be, and we're not. And that is my issue with. And that's probably one of my best out of 25 syndications is that one. And you can still see I'm just frustrated with it because the math just ain't mathing of, there's 20 million in equity stuck there that should have been cashed out to investors. Okay, well then we should start getting some nice quarterly payments, a lot more than our 6% pref. So, sitting in this thing and waiting another 2, 3, 4 years at 6% pref is not something exciting for anybody. I'm sure any of the investors.
Right.
So I started in 2019 is also when I got let go. And I was like, wow, okay, I guess this is it. I wanted to work till I was 40, which would have been 2020. But got let go in 2019. And I was like, okay, I know I'm not going to go try and build my name at some other company. It was a private equity company, and they just knee-jerk reaction, missed the quarterly earnings and cut continuous improvement, which was one of the first things to always go. Right, your vertical operations that run your business have to have. You don't have to have your horizontals, right? Your continuous improvement, your training and development. You can cut those functions and still operate your company. So I got let go, and I stopped doing everything. And I stopped flipping. I had some partnerships. I was like, hey, I've got plenty of single families at 50 some. And I really started pushing syndications. And I started peeling off single families to do some of that. So when I would have an ugly turn, I was like, I'm not coming in and putting another $7,000 in carpet, flooring, paint. If I got to do this or that. I'm just going to put a little bit more. I'll put 10 instead of 7. And now we're going to punt this thing for 115 that my loan is only $30,000. And so selling a lot of those and clearing, 50, 60,000 a house was how I continued every month funding a syndication for a good 18, 20, 24 months to put, $2.5 million across, call it 25 or so, and lending. And I diversified across the country. I diversified an asset class from the hospitality to your normal multifamily to self-storage to triple net commercial, ATMs with Dave Zook and how that's recently gone down. But I went into a lot of things that at the time I'd never been lied to. right? Everything I had done in business turned to silver and gold, right? All my investments had done well. Even when I had a house burn up, right? Okay, insurance made a payout. I built it right back up. And so when I talk about investing and my numbers, I guess I just assumed that all these GPs that I'm talking to are just Zach in a different asset class at a different level. And oh, okay. I mean, they're swearing by these numbers and these plans. And okay, well, yeah, dude, 22% IRR in 36 months and 30% IRR and 30. Like, oh yeah, let's do this one. Let's do this one. And boom, I became just sending wires and selling houses. And so I sold 12, 15 houses. And, we just continually reinvest. We live well below what comes in. And so, next thing I know, you're pregnant out there, right? It's out there. You can't stop it. You can't pull it back. You can't say, hey, send me that money back. I don't want to do that anymore. And just kind of one by one, I start to see little cracks in the foundations and pref payments stop and quarterly dividends stop. And we can't sell this now. And so, okay, well, why? Well, interest, a lot of them got smacked. A lot of them got smacked by interest rates. A lot of them just, I call it guys that were rocket shipping. They were rocket ship, right? You see that on Facebook and Instagram. Oh, they post the rocket ships and they just love this. Oh, we're taking off. And, it was, I invested.
It's funny. Yeah.
I'm the rocket ship guys. Like I never post a rocket ship on, so I just hate that. I like to be a train, just slow and steady and kind of unstoppable. But so I had a loan, a loan go bad. I was in a Ponzi scheme. I've been in a couple Ponzi schemes.
Oh no.
And a couple big ones. Like, I mean, I could do a whole season on Dirty Money, on Netflix. I mean, they could come and just interview me for a whole season because I could talk through a lot of bad things that I've been in where, people are going to be going to prison. And that this ATM machine one is the biggest. Like, I mean, that's over, that's a couple $100 million. And I had big names, Dave Zook, and I had a couple big names that were pushing it. And there were auditors involved that are now going to be caught in this whole thing.
Wow.
So that was a big, big Ponzi scheme. And then oil and gas, which, I should have known, oil and gas, for the seasoned people know that, it's full of a lot of shady characters and it draws a lot of money and interest because our government gives it the best tax incentive there is. It's 100% deductible against your active income. Yeah. So, I mean, that draws a lot of people's eyes like, 100%. Well, man, even if they don't hit this 20-some% IRR they're telling me, I still get to save that tax savings next year. And so I went into two of those. One, I don't know that we're calling it. Yeah, I mean, it was a Ponzi scheme, but at least they captured 60 million. So we should be getting actually payments pretty soon. What percent of our investment, I don't know. But they did shut that one down real quick. Fortunately, well, not real quick. It went on for years, but they said it's very rare that the SEC, locks one of these down while there's still money, because normally you don't find out about a Ponzi scheme until they run out of money, right?
Right.
Fortunately, this one, they were mentioning customer names, and some investor or somebody who's thinking of investing was like, oh, well, I know people at that company. I'm going to talk to that company. And they went and talked to ExxonMobil, and they were like, we don't do business with them. We've never heard of that. And so that's when, it raised the flags, and they got SEC and I don't know, attorney generals, whoever all they got involved. But that's when they found out.
Oh, wow.
2 months after I sent my money, it was all locked down as a Ponzi scheme.
Yikes.
So once those all start toppling, it had me go back to bread and butter. So that's kind of, running my full circle, just to go to things I know they're going to grow in cash flow and take away the risk, the operator risk, the just the risk that's out of my hands when you get into these syndications that has scorned me.
Yeah. Well, and interestingly enough, I mean, I think that despite the challenges that you've had investing in syndications, it sounds like you've learned a lot of lessons, right? And probably too many to share on an hour-long podcast.
Oh, yeah.
But you've also, I mean, just kind of like assessing the time frame, right? That you are starting to invest in these things. I think that was the worst 2-year period potentially to ever get involved in syndications.
So you had the interest rate, the interest rate rise, fastest in American history or fastest in history. And then the other thing you had was an environment of real estate becoming very widely known and accepted as an investment, call it starting in 2018, 19. Prior to that, I mean, accredited investors and syndications and LPs. I mean, I don't know what the data there is, but that market had to be a fraction of what it became by 2023.
Yep.
And so what it led to, especially all these guys on Facebook and Instagram that are trying to rocket ship and show their Bugattis, they realized like, oh, I can do this myself and it makes such little money. Or I can just raise the money and I can do 5 of these self-storage builds and I get a placement fee, an asset management fee, a finance fee. I get all these fees. And I guess irregardless of that, as long as interest rates would have stayed where they were, everybody should have done okay. Right?
Correct.
And the limited partners should have made that return.
Correct.
But with the drop and all the money, all the GPs, I mean, I'm not saying all of them, the ones I got in bed with, I'm sure took out all sorts of nice little fees and chunks and they kicked this financial advisor. I'm sure this one that brought me in, I'm sure he got nice little kickbacks and they did all this. And now, boom, I own 3 pieces of dirt that were supposed to be self-storage builds that by the time, they struggled because it was too many at once to get permits and get the county and the city and the state and to get everything in place. And so they struggled for 18, 24 months to do that. And then by the time they get everything in place and entitlements, oh my goodness, our interest rates are 3.5 points higher. This thing doesn't pencil out now. Yeah. And we drained all that money screwing around. Now, had they only been doing 1 or 2 instead of 5 or 6 at a time, could they have spent their time more focused and done that?
Yep.
And the other thing, unfortunately, I didn't find out about Private Investor Club and 506B group until too late, until I was already basically done with funding syndications. And then I find these 2 groups of only accredited investors and qualified purchasers, thousands of people in them, just talking about sponsors and all this stuff. And then I find, most of them, they don't like this sponsor that I'm with. They don't like this sponsor that I'm with. They never go into oil and gas. And I'm like, ugh. And then I see like, oh, these guys are all investing in things with IRRs between 10 and 15% target. The stuff that I was going after, the stuff that drew my money.
Grand slams. Yeah.
Well, I was 20 and north of 30 because 10 to 15 wouldn't have interested me because I'm like, I'm making 15 to 20 doing my single family thing. So, now there definitely is a place for LP investments. And I just tell everybody, you need to do your homework. You need to join those groups and you need to spend time talking with them on pretty much just reading the forums. They talk about their top 10 sponsors. They interview them. They bring the sponsors on. And they pound them with good questions of what these guys who have been investing in LPs for 10, 15, 20 years, what they know to talk about and look at. And there are a couple of sponsors, if I was to go back into it, the ones that they heavily invest with and recommend that are 20-year track records and much stabler, they're not getting any 20 IRRs from them. but they're getting some of the tax benefits that you get on that K1, and they're getting this, IRR in the 10 to 15. And so there is a place just for me, because of my activity and just because of my stars from them. I'll just continue doing active stuff and lending and single family rentals probably.
So a couple of follow-up questions there, because honestly, Zach, I mean, I really appreciate your honesty, man. It's, you find someone with your level of success, and most of the time you only want to talk about the wins, right? So it's refreshing to kind of hear, some of the setbacks that you've had in your investment journey as well. And it's a cautionary tale, right? It's one, and I run a fund of funds. We place capital into syndications and funds and stuff like that. And for me, it's kind of my job to sift through all the idiots, right? The guys that don't know what they're doing, people with insufficient track records, people with bad reputations that you wouldn't necessarily find out unless you're doing, extensive research and talking to people and really getting the inside scoop. Because what I found is that a lot of the best syndicators are horrible marketers, and so they're great at what they do, but they have no idea how to market themselves. And and the best marketers are the snake oil salesmen, right? They know exactly what to say, how to say it. They promise you the moon, and they fall flat every single time. Yeah. And unsurprisingly, they're the ones that have that have the ability to capture investors in droves, because that's what they do, right? They're just really great salespeople. So it's hard to find great sponsors that are also great salespeople. You have to find them after they've been in business for 20, 30 years. Because by then they've built out, their own sales division, their own, investor relations division that can kind of like, do some of that smooth talking for them. Now, my follow-up question though, and I might be putting you on the spot, you might have to think about this a little bit, but assuming that you could go back in time, right? But you didn't have the option, right? Like you had to invest in syndications at that point. Right? Like you didn't have the option to like stay the course, because it sounds like very obviously you would have never gone down that route. But let's for the sake of this thought exercise, let's say that you had to stick to the syndication route. What would you have looked for? Like, what are you looking for now in assessing those deals, right? What is it that you know now that you didn't know back then that would help you in your vetting process?
Yeah. And honestly, if I could go back to 2019, I don't want 150 single families. I mean, okay, I'd hire property management, and I could hire away certain functions. But I'm not trying to be a business owner. I'm trying to be just a passive investor. And so that's where LP syndications, it hits what my ideal investment would be. I just, partnered with a lot of the wrong people because of the time frame and because of what drew my attention. So yeah, if I could go back to 2019, I would still put a couple $1 million in, but it would be after I'd be following these experts and mostly in Private Investor Club. I mean, the content there, it's just so much great content and expertise from accredited investor and limited purchasers or qualified purchasers. And yeah, I mean, they update their list every quarter of their top 10 sponsors. They bring them in, they negotiate better prefs, better waterfalls. Hey, we're going to bring you $1 million. We're going to bring you $2 million, $5 million. And it's I don't want to say it's background checked, but yeah, I mean, they kind of background check you because they don't want you coming in and being like, oh, I love this sponsor. Oh, they're amazing. They're amazing. And it's your wife's company, right? Something like that. So there is no, they check you. They want to make sure that you're not attached to any type of a general partner relationship or a company. And then, now they do let sponsors present, they would bring in the ones that they like, and they'll have private webinars and and they'll negotiate special terms. But yeah, I would definitely spend all my time really consuming the content and follow the lead of guys that have been doing this over 10, 15, 20 years. Versus chasing, I heard about this one on a podcast, and I like this, and 30%, and look at these tax savings of oil and gas, and ATM machines, personal property. I get 80% deduction in the first year. And chase all these things. And I mean, I've gotten a lot of nice losses, so I don't pay any taxes, but it'd be nice to have all that cash right now and just do something else with it. Yeah, I think it can be done right. You have to significantly lower your expectations on return. I was thinking, because of what I was seeing, I was like, man, I could hit the same returns that I'm hitting on these single families. Now, no, I can't burn my money out, but my cap rate in those single families was in the low 20s, and these guys are talking about mid 20s and 30% IRR. So I was like, why not just keep funding those? Because they did seem sexier, right? Ooh, A-class apartments in St. Pete and Tampa versus Akron single families.
Well, it's the classic. Do you want to be sexy or do you want to be rich? Right? It's hard to be both. And but that is. I'm so glad that we're having this conversation, man, because I thought we were going to spend a lot of time talking about the single family sector and your rent to own model, and I do want to kind of come back to that to kind of wrap up the episode. But I'm glad that we got to spend some time there. Just last question on this subject. You're talking to, say, an operator or a sponsor. What are the things that what are the top couple questions that you're asking a sponsor now that you know what you know to kind of figure out whether or not they're worth investing with?
I see. I haven't had a conversation like that
in a long time.
Ever. Yeah. Because once I found out I knew what I knew, I'm not considering you. Now my conversations are, when am I getting my money back? All of them are past the cycle of what was promised, what was told. So now it's, the one that I'm the heaviest with, unfortunately, is the one crashing, not a Ponzi, but they're the ones failing and crashing the hardest. And that's Lorin. And I've got, over $500,000 across 4 syndications with them. And I finally called it quits on the 4th capital call in 24 months.
Wow.
And I'm a reasonable guy. And so when I got the first one, okay. Yeah. Insurance premiums. Yep. Insurance premium, habitational insurance premiums doubled in Florida. Okay. And those are premium paid in full. It's not a monthly, it's a premium paid in full. Yeah. So, okay, I get that. Now, our rents are above pro forma, so I would have thought, you have a little bit more cash flow, but okay, regardless, okay, so that was a small one. Let's call that I think we had a 6% capital call. Okay, small one. Then, I don't know, 8 months later, financing capital call. 6 to 8 months, maybe 6 months. And I'm like, guys, we just had to have, you knew, 6 months, come on. Well, we need a longer runway. We only had 2-year caps on these. And so that one was an 18% capital call. So now, you're talking, gotta cut it for $100,000 investment. Now you rate another 18.
25,000 between the two.
Now, so now we're up at 25. So those capital calls were all told to us that it was buying us a new lock. Yeah. It was going to buy us another 24-month lock. 10 months later, let's call it, they send another capital call, and it's for financing. And I said, well, and this is deja vu. Well, unfortunately, we were not able to finalize financing, the loan terms, blah, blah. And so you just burned off capital call 2. You just burned it off, an additional expense, interest expense, because you couldn't finalize. You didn't tell us, hey guys, our plan was to buy the new interest rate cap, but we're not, it didn't work. And so right now we're just chewing through your funding. When you have your rents are above pro forma, so you should have excess income. So,
oh my gosh,
I declined that one. The hurricanes happened, right? So hurricanes was more issues there in Florida. And now they just sent out. So what they did there on those 2 buildings, and I appreciate what they did. So they diluted our profit share. They did not dilute our principal basis. So on the capital stack now, we would still get our principal back before they will distribute profit to GPs or to new investors that came in, or the hard money lender, or whoever. So my principal is still secure. I've lost my ability to share on any profit of the sale of the building. All right, I don't care. Like, I'm not going to follow you. And I'm glad I didn't, because now they came forward with another capital call again. And this one is for, hurricane damages and something else lender related. Yeah, they still, on a couple others, haven't financed a lender. And so this one, now they're threatening that we will see material dilution. So they want it 22%. And if not, our investment will be severely to completely wiped out.
Wow.
So that's one building. Yeah, that's 100,000 in that building. And I talked. So I have a close friend who used to work there with them.
Yeah.
And he's also connected to other people that are at this company. And one of them is invested. And both of them were like, no, we're not giving these guys an F and dime.
Yeah.
Like the trust is lost.
Just come on.
Because anybody, as long as they had access to the money, would say, okay, I'll send 22 to protect my 120 or 110, whatever I had left of that.
Yeah.
Yeah. But all you're doing, yes, you're protecting it for this minute, but how much do you trust the execution of the sponsor?
Right.
And foreclosures have already been filed across a bunch of their assets. So that's what they're trying to get out. These lenders, these hard money lenders have filed, the banks, whoever, have filed foreclosure. So it's like, guys, it's not just the 20%. That's only going to give us 6-8 months. And then you're going to see another one. And now you're going to be into it for 140 and they're going to ask for another 20. And then you're going to be like, oh, okay, I'll throw another 20 and I'll lose my 140. And then,
it's just compounding. Yeah. Makes sense.
For me, it's like, I'll sleep, since I've already kind of washed away that money. This money that's been out here and all, I'll just sleep better. Just be like, okay, it's gone, versus sending another 20 and okay, what's going on?
The delay and pray kind of thing, right? Where that makes sense, man. Well, and did these guys in business for a long time before this, or were they kind of doing? Yeah,
they'd had like 5 years of success, and the earliest one I did with them, and so I had that data point. I put 50,000 in the first one I did with them in 2019, and I got over 100,000 back in 2020. So it was like a 16-month hold, a 56% IRR.
Oh wow!
So I had that data point. So when I knew they were in St. Pete, I have a place in St. Pete. I've been going there for 25 years. Oh man, you got a place downtown St. Pete? Yep, I'm in. Oh, you're getting another place in St. Pete? I'm in.
Yeah.
Oh, you're getting a place in Tampa, on the water in Tampa? Oh, I'm in. Tampa, St. Pete's was the largest growing MSA for a couple of years.
Yeah.
And you can see the cranes still rushing to support it there downtown.
Yeah. That's that is definitely that's a rough experience that you've had. And it's definitely not all sunshine and rainbows. And just to kind of put a bow on this conversation, coming back to what your bread and butter is, right? With the rent to own strategy. So eventually you're like, hey, screw this, what's done is done. I'm going to go back to what I know. And I think there's a lot of power in that, man. Cause truthfully, it is easy to get shiny object syndrome, right? In the investment world, because there's so much out there, right? And people make money. There's a million ways to make money, right? And so it's interesting that you kind of, trial and error didn't really, didn't work out the way that you expected it to, but you went back to what you know. And so now what is the game plan? Because you still have about 50, right? You went from 60, now you're down to 50 homes.
So I went from 60 to 40 and then back up to 51 now. Nice.
Yeah. And so this model is you get the tenant in there. They're putting 2,500 down, rather, right?
Yep. Small deposit. Yep.
2,500 down, and then it's a rent to own contract. So how does that work exactly?
You could call it more of a rent with purchase option. So that's my term. This to help separate land contract from the thinking. So some people, rent to own, do I own this in 10 years, 15 years? No, this is a rent with purchase option. So you're never going to own it unless you go get a mortgage, or I actually had somebody, her parents won the lottery and they gave her the money and she just bought it in cash. So it's crazy.
It's so cool.
So it's a rent with purchase option. Every contract covers them for 3 years. You know what your monthly is going to be. You know what your purchase price is going to be. At the end of 3 years, they both change, right? We go to a market price, whatever market is in the house, whatever market is on the rent. I carry over the deposit. I carry over some credits, $100 a month for every month. So I carry that all over to come off that purchase price. And they have another 3 years. And at any time they can purchase the home. At any time they can give me a notice, a 60-day notice, and say, hey, we're leaving. That's fine. You don't have to buy it. It's just an option, and I don't have to sell it. That's why I give you forever. I don't. Now it is. I had a buddy, my best friend was doing that strategy. But then, he's trying to get to FI, right? We met at work. He's still in the engineering division. They have a new baby. His wife works. He wants to get to financial independence, to FI, like I did through houses. Now he started too late, but he's building it and he's doing RTO, purchase option. And oh my goodness, he gets a text or a call like, hey, I got my financing. I'm going to buy the house. We need paperwork. And he's like, Zach, they're getting their loan. I'm like, well, yeah, it's a possibility. It's like, well, and I'm like, yeah, you're losing your chicken. You're going to get an egg, you're going to get, but he wasn't as far below on his basis versus market. So I think he might've only got, $25,000, but he lost $500 a month. And what I tell everybody, you can't retire on 25,000, but you can retire on a bunch of 500 per month. Right. And so he had 2 tenants buy within his first 3 or 4 years. And so he's like, yeah, I can't do it anymore. I was like, no, I don't think you should. So what I tell people, if your objective is to get to FI, it's not the best strategy because you can lose your assets and then you get that money, but what are you going to do with that money? You need to go make a return. Yep. And so, I think it's a sound strategy for someone who has a large enough portfolio that they want to get more passive. And if they can continue, so the catch is if you lose that asset, you're either going to decrease your delta between your net income and your expenses. So that's one of my key KPIs is our family delta, right? What's the difference between our net income coming in monthly and our total expenses, including I amortize everything, our vacations, our Christmas lights, our pool expenses, right? Everything, because I'm a data guy. So I want to know, we have all these expenses that are one time through the year. Nope. Divided by 12. That's what it is monthly. So I can see, our expenses add up to quite a bit, but our income is quite a bit. So if you lose that house because the tenant bought it, your delta is shrinking between what's coming in a month and your expenses. So are you okay with that shrinking, or do you need to go find another asset to still bring home that $400 a month that you lost? And if you take that 25,000, okay, you put it in T-bills, now you're making $50 a month instead of $500 a month. So it's a tough strategy. It's certainly a hard strategy for someone trying to grow. And it just becomes a way to think about it when you become seasoned and you have a large portfolio. My model now is, I'm seeing maybe about 5% buy a year. I'm seeing 2 to 4 people buy a year, and I'm able to buy more than that per year in houses, which is good because I wanted to grow. Right. But even if I want to hold in my mind, I want to hold steady over 50. So if 2 to 4 or 5 people buy a year, I've been able to buy 2, 4, 5 houses a year. I'm holding steady, and we're still living at about 50% of what comes in a month, even with everything we have. So it's still snowballing, right? 50% of what comes in still snowballs into an investment.
So one of the things that I'm a little unclear on, right, is what would the inherent advantages be? So one advantage I could see is the tenants take better care of the property, right? But what would the inherent advantage be of like a rent to own strategy versus just like, hey, I'm going to burr this property, rent it out for a certain period of time. And then, when I want to sell it, I sell it. So like, what is the net difference to you, right? And what are the net positives to you? Because obviously you're not just doing this. Maybe you're doing it for philanthropic purposes, right? But there has to be some sort of benefit too that I'm missing here.
Maintenance calls. No maintenance calls. That's the simplest one, right? You're not getting a call because the toilet, because the screen door, because this light isn't working now. They become responsible for all the minor repairs and maintenance.
I see. Got it.
Now, your thought process, they should be taking better care of it. You would think.
Yeah.
But then you certainly have this weird other end of the spectrum of people who are like, this house he's never going to come here. He's never going to walk through it and inspect it. We're never going to have a security deposit review. And, I had 2 turnovers, and they were not evictions. They were both just turnovers where they chose to leave. And they were both like 6-7 year tenants. And those houses, you would say they were uninhabitable. I mean, they were
really.
They were horrible.
Really,
one of them cost me about $16,000. Yeah, they were both around that $15,000 to $16,000 to turn around. I mean, mice infested, filth, leaks, mold, and so these were just filthy animal people that eventually let the house get away from them and just said, "Hey, we're gonna jump and start over." And both those houses, we had to do like 2 30-yard dumpsters of their stuff. I mean, that's how much junk and crap.
Holy cow, dude! Oh my gosh,
they just had to start over. Their house is mold, poop infested.
Bro,
mice.
I'm gonna title this episode "Real Estate Horror Stories" with Zach Zimmer. Why to not invest in real estate with Zach?
So now I had a third ugly turd around the same time frame, and that one I chose to punt. I just punted it to another investor and got my equity out of it, right? Pocketed, $40,000 or something. I looked at that house and said, I don't like the house. I don't like where it's at. I'm going to put 15 into it, or I've owned it a long time. I've owned that. That was one of the older ones. I'd owned it like 8-9 years. I know the loan balance on this has got to be like 25,000. And I know in its current state, I can sell it for 65. And so I just did a little return on equity. And so I look at that quite often when I'm thinking of selling something. What's the return on equity? So this house is worth, let's call it, it's worth 70 today. My loan balance is 20. So I have $50,000 stuck in that house. Got it?
Yep.
If I got to put 15 into it to get it rentable, that means I'm going to have 65 stuck in this house.
Correct.
So I'm going to have 65 to cash flow 500 a month, right? So 6,000 on 65. So what's that? 9% ROE? Yes. So 9% ROE on a house like that, I can lend that money to my flipping buddies at 15%.
Correct. Yeah.
So why not make 6% arbitrage there? And so that was one where, I knew some other investors. Hey, who wants a deal? You're gonna have a good cash flowing property for new investors, out of state investors, and got out of it, took that money, and I lend it. Who knows where those exact dollars went, but my money is either being lent out to a bunch of real close flipping friends at 15%, or it's being cycled through rentals, through a BRRRR process.
Yeah, that's awesome, man. And this, despite this, all jokes aside, I mean, I think that you have clearly built, you've clearly built a successful portfolio and gotten to a point where, you're maintaining. It sounds like right now, you've got 4 to 5 deals that you're selling every year, but then you're replenishing that stack and you're trying to grow the portfolio too. So that's really. That's really great. Now, last question here about the rent to own, because this is something that I wanted to ask you since the beginning, and it just keeps getting lost in conversation, is the rent to own, the purchase option at the end. Is this a fixed price that you negotiate up front, or how does that work?
Yeah, it's fixed at the writing of that contract. So it's good for the next 3 years. And then at the end of that 3 years, everything, updates again.
Yep. Yeah. So in an appreciating market, that is... it's great for the tenant because the tenant's like, okay, well, I'm locking in this price. Right now, though, probably the deals that you signed 3 years ago, I can't imagine that a lot of people are taking them, right? Because I don't know how your market's working, but ours is kind of wonky.
Yeah, so ours is still, let's talk on that real quick. So I had people that made more money on the house than I did. People that signed before COVID. Yeah. So people that signed in 2018, 2019.
Oh, yeah.
And then they exercised it 22, 23. So they bought so I was all into that house for 45. My purchase price to them was 75. Well, that home appraised for 110, 115. So they could have made, maybe some of them did just flip it around and sell it. I don't know. But I had some folks and it was painful. So my market, unfortunately for me, you can't be fortunate and unfortunate. Fortunately, I live here. Unfortunately, with internet, everybody knows about Northeast Ohio as top 10 in the country, maybe top 5 in rental returns. Yeah. And so millions a year is coming here, maybe even millions a month. 2 of my friends, you can't fight it. It's like globalization. You can't fight globalization. Well, you can't fight investor cash flow coming to our area to buy houses. So they sell to it. They sell turnkeys. And, they're selling hundreds of turnkey rentals a year. And so that's keeping the market up because those are selling, I don't want to call it an artificial price, but it kind of is. It's a price above owner occupant. Investors are paying more than owner occupants would. And that is a market problem. Because that's not real. It's artificial.
Right.
And so, but they're doing it because they can't cash flow in Arizona. They can't cash flow in California. Right. They can't cash flow in New York. But they can spend $130,000 and collect $1,300, $1,250 a month in rent. They're getting depreciation. They're getting their mortgage principal pay down by the tenant, and they're cash flowing, $300 a month. So that is keeping my market up, and it's creating more competition for owner occupant homes because less are going to the owner occupant market because they're being sold to these turnkeys. And so, the prices, if I have a turnover from a year or two ago, it's probably staying pretty close in price and in rent. But from 3 years ago, I don't know, it might be going up. It's probably up a little bit from 3 years ago.
Nice. Yeah, that's interesting, man. It's interesting to hear how the market's kind of behaving in different parts of the country because, it's definitely kind of like a weird time right now. Although, people think, oh, wow, the economy is we're kind of in a rut right now. I don't know if we're necessarily in a recession yet, quote unquote. I guess that's debatable, but most people don't realize that actually real estate tends to appreciate during bear markets. 5 out of the last 7 recessions, real estate's gone up. It's only like 08, 09, where the housing crisis was the impetus for the for the stock market crash. And I think it was .com maybe, where real estate went down a little bit. But real estate, generally goes up during these times. But we'll see. But this is we are way over time, my friend. But I really enjoy your perspective. I think that you've learned a lot of lessons, and you are, you're gracious enough to kind of share those with the audience. So I want to thank you again for your candor. And before I let you go though, Zach, you've shared a lot of nuggets so far with the audience, but I'd love for you to be able to share one final Gould nugget with the audience. Take it away. Living below your means. And it's something, it naturally came to me as just a saver investor. We lived on my W-2 when my rental business was more than 3 times what came in. So it was doing well. I mean, it was easy to live on that W-2, but not that easy in today's world, where, oh my goodness, you're only spending a third, or 20% of what comes in every month. Like, why are you not living? And so by living, it's tough to say a Porsche was simply, but it was a Porsche Macan, right? It wasn't the Porsche 911 Turbo, but like, we still had nice things, but we lived on my W-2, and we saved and invested and let that snowball become enormous. And this fact, or this way of living, it was recently put in front of me pretty drastically, of a connection that a friend, and this is a high earning friend. We're talking north of 500,000 a year. And they wanted to get together to talk about an issue. And hey, I made a bad investment. I lost a bunch of money, a couple $100,000. And, I got this, I took a loan and I took this. I'm like, you're making $600,000 a year. You're 47 years old. How come you couldn't lose a couple $100,000? Like, I lost a couple millions. Like, and you're at the peak pinnacle of the W-2 hierarchy. Yeah. And that's when it came out that, when I said, well, what's this? And he didn't know. He did not have a breakdown of what their spending was, and did not know anything. And when we sat down and did the spreadsheet analysis, including his quarterly $5,000 bonuses, they were spending every dollar that came in, like their standard expenses between all the high life. And this is a person at 47 that should be worth millions of dollars, that has a flat to no net worth because of living at their means. That's brutal. And so I was like, wow, like this is bad. Like, we can sit down with your wife and talk through like really big change in mindset, or you guys are never going to be able to retire. Yeah. And so that's the Gould nugget. I love that, Ben. And that's great that you were able to kind of provide that advice, and I totally agree with you. I mean, it is sad to hear those sorts of things, but those examples exist in droves. Well, and this isn't somebody trying to be flashy either. This isn't somebody. This is just people living at, like the Joneses. New cars every 2 years, and just a ton of spending, like it doesn't even be seen, just like Amazon, Target, Kohl's, Dick's, just like a ton of just expendables, not even assets that depreciate, just little like things that get thrown away in 6 or 12 months. And and so those are the things that kind of bother me the worst. So we're good. My wife, we do well at keeping expenses managed and trying to constantly drive that income up. It's awesome, man. That's awesome. Well, Zach, I want to thank you for your time, man. And for those of you who are looking to connect with Zach, all of his links are going to be in the description box down below. Zach, it's been a pleasure, man. Thanks for hopping on.
Yep. Thanks for having me. It was great.
Awesome.